Let's talk about you and your money, and today we're exploring what 2025 might have in store for investors and the economy. Liesl, what are you and the team at WHZ anticipating?
We are anticipating, so a few things to watch this year. We were just talking about it. Interest rates, that's definitely one, and again, we'll be keeping a close eye on that. Politics, so I'll talk a bit about Trump and what his policies are, and if any of those actually do come through on those campaign promises. We'll talk a bit about technology as well and how that's changing. But we're saying the name of the game really is going to be agility, so ability to move pretty quickly on some of these changes. So we'll see in 2025 there certainly will be some things that will could have an impact on markets and the economy. So I'll start with interest rates, and there will be, some of the things that the Fed will be watching is inflation, and I'll talk a bit about how that might be impacted with some of the policies Trump is planning to put into place. But really, their stance on interest rates will help us figure out exactly where we're headed. And so, like I said, they made a half a cut in September and then another quarter point cut in October and December. But they've indicated that likely over the next 12 months, we'll see another couple of cuts. And I think that's less than what we were expecting a couple of months ago. And again, that's why we did see some of that volatility in the markets over the last few weeks. So that definitely can have an impact on investors.
Liesl, I consider myself an average investor. So how might these rate cuts affect me, the average investor?
Yeah, well, so the rate cuts, they should help support both the economy and obviously corporate earnings as well. But on the economic side, again, back to if rates are higher, people are potentially not getting mortgages or getting cars. But as those rates come down, people will start to spend again. And that'll help to push corporate earnings higher. So that's really helpful. Also, companies, when we have lower interest rates, they're able to invest in their companies to help grow them. So that will help if you own shares of a company, then if that company is doing well and they're able to invest and create more revenue, then that's going to benefit you. So we will note, though, and that's as a result of the last meeting that Jerome Powell had reported on, is that longer-term interest rates have remained somewhat elevated. And with, again, some of the potential policies that may come through, it might mean that we could see some reduction in taxes and revenue and higher spending on the consumer side. So we want some flexibility to, again, if we need to, control inflation.
Liesl, is part of your job description keeping an eye on the Fed on a day-to-day basis so that you kind of can stay a step ahead of what's going on with the markets as the Fed affects the markets?
It does, yeah. I mean, in the short term, it can. So like I said, there were the jolt in the markets over the last couple of weeks because of it. And so that has an impact on the short term. But longer term, I mean, what do we do with portfolios and things? It's interest rates have an impact on the bond market. So if we can pick up some additional yield and some term bonds, then that's helpful to portfolios. So it certainly is something that we keep an eye on, especially over the last year and a half. And it's been a we've gotten, I think, what we've expected, but there have been some surprises along the way. So that does have an impact on short-term markets.
All right, let's talk about the political landscape. And you've referenced the administration change a few times already. But with that happening in a couple of weeks, how might the incoming administration affect the markets?
Yeah, so I will say that regardless of whether Republican or Democrat is in office, there's so much data to support that markets have grown in any administration. So it just sometimes there's events like geopolitical or other events like the pandemic that happen that cause markets to go off. So it's not so much that the president has a huge impact on the markets directly, but some of their policies definitely can impact that. So he's proposed several policies on the campaign trail, and one of them includes potential corporate tax cuts for companies, and so that would be from the 21% rate down to 15. So that's a pretty big rate cut that would have companies showing higher revenues and earnings because they're not taxed as heavily. So that would be a positive for stocks and of course, and that's for companies too that produce goods in the U.S. So if we sort of transition into, I know you've mentioned a lot about tariffs, and so our position on that is that these are more of a bargaining chip, the tariffs, but certainly that could have an impact on people in markets if things are more expensive. Again, that's going to hit inflation, and that's going to cause consumers, maybe they're not able to purchase as many goods or services if things are a bit higher because they're made in back in the U.S. or there's tariffs on things coming in. And usually tariffs are passed on to the consumer. So those are something that we would be watching. But again, we think that's more of a bargaining chip that he's trying to play to work with some of these, especially Canada and Mexico on immigration and topics like that. So something to certainly watch. And then there's proposed changes to personal taxes. So the Tax Cuts and Jobs Act that he put in place back in 2017, which had adjustments to your standard deduction and things like that, and tax rates were lower. We also had adjustments to the we call it the SALT tax, but state and local property tax. And so those things, if he extends some of those, then that would be a good thing. We'd have lower taxes. But on the, he also mentioned things like Social Security taxes. So if we aren't getting, if elderly, they're on Social Security and they're not getting taxed, they have more money to spend. So certainly those would have an impact on overall. But again, it's less, or it's more money in the consumer's hands in each of these cases. So that's positive on the growth side for sure.
Let's, Liesl, get into the aspect of technology. That seems to be a continuing theme.
It does. Certainly with technology, I mean, we've seen a lot of advancements in artificial intelligence or AI. And so I don't know about you, Wayne, but when I sign on to my, bank account now, it pops up and it'll say, oh, here are some insights, and it's reading off all these things about what I'm spending my money on and everything else. So certainly that's going to automate. AI will automate routine tasks. It'll enhance personalized service. So again, that you sign into your bank account and you're getting all these insights. It'll optimize operations across different supply chains and hopefully help to make decisions faster because you have more data with analysis. I know when you Google things now, you write a question and you get a response through AI. Obviously, of course, with all of this, you have to consider ethical and making or using it responsibly. So making sure that you're checking on some of those sources, but it's nice that you don't have to click into a link to actually to get the answer to something. So all of this will have an impact on businesses because it'll improve productivity and it'll enhance margins and earnings for companies. If their employees can be more efficient, that's going to allow them to do potentially more tasks. And so the thing to watch out for, though, is if companies aren't adapting to this new technology, it's possible that they could be left behind. So that's something that we feel is very important, and especially when it comes to investing. You've probably heard the Magnificent Seven, so like companies, NVIDIA, Apple, Amazon, those types of companies that are putting a lot of money into AI and other technology advancements. They're really the innovators that will be sort of at the front of this. So certainly something to look at and consider.
Other than informational things, when you look at, for example, you talked about the bank account, how trustworthy is AI? After all, this is just a computer program, and it sounds to me like something that we shouldn't put all of our faith in. It's just one tool we should use to learn about our investments.
Yeah, exactly. I mean, it's that you get that quick answer from AI, but also checking a reliable source is something that is important to do. And it's funny, I'll ask a question that I know the answer to just to see what the outcome will be. And I'm like, okay, that's actually pretty good. But you still need to do your due diligence on everything. So that is something to watch for.
And Liesl is a reliable source, by the way. We've covered a lot of ground this morning already, and I'm sure there's a lot more we could talk about. But how would you summarize the major things to know for 2025 and watch for in the financial landscape in this coming year?
Yeah, I'd say there's three big takeaways to keep in mind. Obviously, coming into 2025, the U.S. economy is certainly in a position of strength, and we've seen solid growth. We have that continued technology innovation, and we have a supportive Fed in terms of interest rate policy. So there are definitely concerns to monitor. There's always risks to consider, but definitely the fundamental economic backdrop remains pretty positive there. Number two, we say market valuations certainly are considered elevated. The S&P's PE ratio, so PE stands for price to earnings ratio of stocks, is above sort of what the average is of 20. It's at 22 right now. So maybe it's suggesting that investors should be definitely strategic and disciplined in their approach, and it's maybe not time for excessive risk taking, but thinking beyond some of those bigger names or things that may give some additional potential growth in 2025. There are other things to consider. I mean, from interest rate to the new potential administration policies, but the key to success, and I mentioned this early on in the program, was that keeping that long-term investment strategy and just reminding yourself, especially on days of volatility or significant, especially down. So you never hear from clients when markets are up, but when markets go down, you definitely want to remind yourself about the long term and not to let the short term knock you off from your personal goals. So really important.
You don't hear from the clients and the market is up. I want to hear more about that. I would think if the market is up, you're going to get people saying, I want to take advantage of this and do better. So what does that mean? Yeah, no, it's true. It's true. You don't, I should rephrase that. You hear from clients more when markets have a downturn and they get a little nervous about intraday market downturns. So, of course, clients that are very bullish or optimistic about future growth are always looking for investment opportunities, and of course we're there to support those. But you hear from clients a lot more when you have a 1% or 2% down market. So yeah, I totally understand that. People going, oh no, should I trade? Should I sell? What should I do when times aren't good? But nonetheless, are there other specific actions investors should think about as they navigate 2025? Yeah, well, again, keeping that long-term focus, and at WHC we do use our plan well, invest well, live well process to help our clients develop those strategies. So then when markets do go down, we bring them back to their financial plan and we say, okay, remember what your financial goals are. And by the way, we've incorporated in the modeling some of these ups and downs. So they happen, they're part of it. And let's just remember that this current environment, while it may be challenging sometimes to look at statements and things, that we focus on the long term. But there definitely are a few things. I mean, last year with high market returns, consider rebalancing portfolios to make sure they're aligned with your original stock portfolios. So for example, if you have a 60% stock portfolio and you have 40% bonds, last year with stocks performing much better than bonds, you might have a little more of a weighting towards stocks, so you may want to rebalance and bring it back to that original 60-40, just so you haven't drifted too far from your target mix there. And then second, taking advantage of the current current interest rate environment, and making sure that, again, on the bond side, you might have the opportunity to, and it's probably you're kind of getting into that point where it's beyond that, but you want to make sure that you've positioned bonds appropriately and taking advantage of the higher interest rates over time. And then lastly, opportunities to diversify. While U.S. markets have performed very well, always having a broad and diversified portfolio will win over the long term. I know I rattled off some year-to-date or 2024 investment returns in each of the different indices across the stock markets, but again, if you have a diversified portfolio, that's going to win over the long term. Eliza, you mentioned the 60-40 ratio. Specifically, what does that mean? Clarify that. Yeah. So
in our industry 60-40. It means 60% of your overall investment mix is in stocks and 40% is in bonds. I mean, that's probably the most typical investment mix that a lot of investors have. But again, on the spectrum of risk, some might have 50% stocks and 50% bonds. It really just depends on what your risk tolerance and time horizon is. And that's something that we assess when we work with our clients to make sure that whatever portfolio they have, it's invested aligned to their financial goals and also their risk tolerance. Because again, while we want to make sure that they have the long-term growth, we also want them to be able to sleep at night. And if they have too much risk, so if they're in 100% stocks, they're maybe feeling a little jittery, well, probably feeling very jittery when stocks go down. So anyway, assessing that and making sure that you're in the right mix.
So what are the best ways for our listeners, our investors, to stay aware and be ready to react to change in 2025?
Mm-hmm. Again, focusing on long-term goals, maintaining that disciplined approach, and then not letting short-term markets movements derail your strategy, and that's the focus. But again, keeping an eye on investment news, and there could be pockets of opportunity. In our investment committee, we meet at least quarterly to determine, do we make any big shifts? And so sometimes there's opportunities for us to meet more often and determine if we need to make any shifts, especially so we'll be, again, watching very closely the new policies, interest rates, and all that 2025 has to offer.
Great advice. And if our listeners want to learn more or get in touch with you for your help in navigating their financial future, Liesl, how do they do that?
Well, they can visit our website at whzwealth.com and schedule a complimentary consultation, or they can call us directly at 860-928-2341. And we also have an e-newsletter that is emailed out every month, and also this show gets turned into a podcast. And we also have a YouTube channel where we post a couple of great videos as well for some insights onto different things that are happening in the market. So all of those things are great ways to get in touch with us, and that can help you with your financial situation.
We haven't talked about the YouTube channel show. I wasn't aware of that, but is it WHZ Wealth, or how do people find that? I guess a simple search would find it?
Yeah, yep, exactly. Yep. So, and then you can subscribe to our channel that way. So
all right, that's Liesl Langevin, Senior Vice President and Financial Advisor at WHZ Strategic Wealth Advisors. Liesl, always a pleasure. Thanks for joining me today.
For more information regarding wealth management and customized financial planning with WHZ Strategic Wealth Advisors, please visit whzwealth.com. WHZ Strategic Wealth Advisors offer securities and advisory services through Commonwealth Financial Network, member FINRA SIPC, a registered investment advisor. Fixed insurance products and services offered through CES Insurance Agency. They practice at 697 Pomfret Street, Pomfret Center, Connecticut 06259, and 392A Merrow Road, Tolland, Connecticut 06084. They can be reached at 860-928-2341. WHZ Strategic Wealth Advisors do not provide legal or tax advice. The tenured financial services team strives to support clients in achieving their financial life goals while providing absolute confidence and unwavering partnership for life.